Everything in this video is not intended as financial or investment advice and is for educational purposes only. I'm Josh Olszewicz, the head of research at Valkyrie, and let's take a look at the midweek market update. I was out last week. See, I didn't really miss much. We continue the technical term, which is chop in the markets here. Let's start by looking under the hood first, which most people deem akin to fundamentals as opposed to technicals, which are strictly price. So in general, when you see a lack of volatility, a more bearish outlook or picture, you tend to see on-chain activity on anything, crypto, digital assets, start to decline a little bit. You see volumes decline. You see website hits decline, just visits, Google Trends decline. And it gives you a sense that the activity is certainly down, obviously, but also when that changes, that generally tends to be an important signal as well. So across the board, really for Bitcoin, Ethereum, other blockchains, in general, you can pretty much guarantee you're seeing a decline in on-chain activity. Bitcoin here, transactions per day, ranging, nothing really new or changing there. ETH's transactions per day, curving down a little bit. ETH is seeing a decline in fees as well, which you would generally think would be a more bullish than bearish indicator. But again, as a measure of activity on the chain that scales kind of poorly, you do really want to see fees higher rather than lower if you're bullish in the ETH ecosystem. Obviously, as a user of ETH, you want fees to be as low as possible in general. But to see fees decline is a signal that you're seeing a decline in activity, and a decline in activity generally is coupled with a decline in price. So you're seeing ETH transactions per day continuing to droop here, which isn't bullish in the near term, certainly, but isn't unexpected based on price. Everything is settling down, hype is settling down. We're establishing this new normal. ETH went from zero activity, ICOs come, blah, everybody's euphoric, excited. Everybody wants to participate in this new crowdfunding platform, whatever. Price starts to decline, that activity's gone, right? Here's your new floor, your new base. All of a sudden, DeFi gets unlocked on ETH in 2020, 2021. Everyone's excited. Everyone's loving this Lego financial composability, whatever, right? And price sort of calms down. And then ideally, we get this new floor that's forming now in activity. Much of this is just DeFi, DEXs, ETH just computing stuff and things, mainly for DeFi, a little bit for NFTs as well. So it's certainly not unusual to see activity move a little bit lower here. Bitcoin active addresses as well. Again, ranging, moving lower, nothing too exciting going on here, right? On-chain activity-wise, we're not seeing large week-over-week rises in on-chain activity or falls for that matter. This decline here was more mining related than anything. Miners, if the chain is proof of work, miners are definitely included in these on-chain activity metrics. So it's important to understand that. So if, for instance, Bitcoin starts to see a decline in hash rate, which it is, then we're probably going to see a decline in on-chain activity relative to those miners that are no longer active on the chain, with the assumption that a decrease in hash rate represents a decrease in ASICs. There's caveats all over all this data, and I'm sort of oversimplifying it. But in general, if you see ASICs come off a chain, you see hash rate declining, you see on-chain activity declining to an equal degree for the most part. ETH as well, active addresses, basically flat. ETH will have its moments. Things will happen. You'll see NFT mints happen. There's a bunch of excitement one day and then nothing the next day, right? You'll see an NFT mint some coin and on-chain activity explodes. Prices, transactions explode, and things kind of scale poorly. So everything sort of is like, blah, happens all at once and then dies off, right? One of the reasons why Solana keeps going down as a network is because it cannot scale when it has this surge of activity, right? It just sort of shuts off. So each blockchain certainly has its growing pains, some more tolerable than others. But again, on-chain activity generally declining here. Here's Bitcoin hash rate, and it's certainly looks like it's peaked for the moment, which is kind of what you'd expect. We're getting warmer weather in North America, in the US specifically. Summer is coming in Texas. You're seeing curtailing of power for miners in Texas. You're probably seeing some miners in Texas struggle with the heat and humidity as well. And you're also seeing difficulty continue to increase. So all this means collectively, mining profitability is going down. And if you're inefficient, if you are using older miners or if you are using expensive power, right, then all those variables that plug into the mining profitability equation mean that you are no longer profitable. And for some people, they cannot afford to continue mining if they are no longer profitable. Again, if people just assume, oh, we're no longer profitable, we're shutting off everything and waiting, right? That isn't necessarily the case for everybody. That's definitely a generalization. Maybe it's truer for the miners at scale, but even then it's hard to really say. They can do all sorts of complicated financial engineering and raises, and things can these days navigate that profitability decline much better than maybe they did in 2015 and 2016. But nevertheless, hash rate declining here slightly. And really the bigger story lately has been miner selling. So this is miner net position change in BTC terms. And you can see, just to compare and contrast this, 2016, 2017, even with the continuous rise in price at that time, we still saw continuous miner outflows, basically. Miners would acquire coin and they would sell, or miners that were holding coin were selling all the way up, which is generally what you want to see. It's better for everybody. You want to see whales selling on the way up. That's just the way it is. You don't want to see, which is what happened in 2018, whales selling all at once, because then that pushes the price much, much lower. You want to see people selling into strength. And then in 2019, 2020, miners mostly held an extended period of just holding coin. And then they began selling again on the way up. This was mainly one large miner in China, but since that time, since early 2021, most miners have been holding coins. And you've probably seen headlines about so-and-so's holding so many coins. And, as a Bitcoiner, it's great. But as reality sets in, and this thing is still fairly volatile, right? We're down 50% from all-time highs. And companies need to have operating capital and whatever else they need to deal with, right? Overhead, etc. So miners have to toe this line between, am I going to trade these coins basically as a position, or am I going to figure something out as you do with a commodity, deal with options, deal with futures, whatever, to protect yourself from the downside here. So what we're seeing now is the past month, miners selling based on the wallet movements. Again, tons of caveats with this because they could have already sold to somebody in a futures product, an options product, some OTC deal, right? You have no idea necessarily what each miner is doing on aggregate other than what they tell you in their public statements. So the on-chain activity really can only take you so far. It gives you a good idea. It certainly correlates with the down prices in the market. It makes sense logically, but it doesn't necessarily mean it's the entire story. So it's important to look at, it's important to know what's going on, but it's not always telling you everything, especially nowadays with how complicated miner financing has gotten in general. If you look at ETH Hashrate, still screaming. This is something I don't really understand. My guess is because most of ETH is mined with GPUs and not ASICs, GPUs are much more flexible in what they can mine. So if I have a bunch of GPUs and I want to point it at ETH today and some other chain tomorrow or in the next 10 seconds, I can do that. I think right now, ETH is still the most profitable for most of these GPU miners. ETH does have ASICs as well, which are specific to the ETH algorithm. But because ETH is mainly GPUs, I think, they can wait till the last minute, till the lights go out, right? Which is what's going to happen when ETH goes from proof of work to proof of stake. They don't really care as much because they're not looking to get ROI before the apocalypse happens, right? When this goes to proof of stake, for them, that's game over. They have to find a new chain in town. There are other ETH algorithms. It's called ETH or some pronunciation thereof. And they can go elsewhere at other coins, certainly not at this profitability level for them, but there are other options. So you'll see when ETH does finally switch to proof of stake, you'll see other chains sort of absorb that hash rate. But for now, hash rate on ETH basically just like BTC, it's down from highs slightly, but it's still holding those highs rather nicely. If you look at BTC on exchanges, flat, ranging. We're not seeing a ton of coin get removed from exchanges like we did from March to May. We're just sort of ranging here. Again, nothing too exciting to comment on one way or the other. Even recently, coins may be leaving over the past week, let's say, but in general, still ranging. And on ETH as well, ranging. One thing we're not seeing is a bunch of coin get flooded onto exchanges, which is a bearish scenario, most likely, where you'd see increase in supply, whereas demand is declining or staying the same, right? Obviously, prices would most likely drop in that situation, but you're not seeing that in either case for Bitcoin or ETH. And I'm focusing on these two just because they kind of lead the market in a lot of ways. Bitcoin Lightning Network, which is similar to a debit card system. If you're not familiar, it allows cheap microtransactions through a series of smart contracts. Hub and spoke model is what it is. And basically it's effectively like a restaurant tab where you can keep something open on Lightning until you settle it on the main chain, which would be the Visa network equivalent. So continuing to see BTC get deposited into layer 2 means it's not sitting on layer 1 and potentially not being sold, right? Again, there's tons of caveats. People love to read into this data and say, oh, look, all of this BTC is being locked up in Lightning. Not necessarily the case. The same thing with DeFi, TVL. There's tons of ways this can be traded and sold. That doesn't necessarily mean moving it directly to an exchange. ETH also has a very strong supply soak mechanism currently, and that is ETH being staked ahead of the proof of work, proof of stake transition. Some of this is liquid staking, meaning it can be taken away at a moment's notice. Some of it is hedged in DeFi, right? None of this stuff is exactly a pure picture of what's going on, but it gives you a good idea. And there's currently nearly 13 million ETH being staked ahead of the transition. So again, you're not seeing a bunch of this ETH get sold somewhere directly. This isn't declining. This is only growing, which is good for ETH long term. And it makes you wonder what the price would look like for ETH if this wasn't the case. In a lot of ways, to me, ETH is acting like just another altcoin. Well, at the same time, price-wise, it's not down 85% from highs like some of these coins are. So it's kind of a mixture of both. Whereas you might think with the fundamental supply soak like this, price would be doing better. It's not doing better than BTC, at least over the past couple of weeks, certainly. Another metric we can use for on-chain activity and sort of mapping that onto price is MVRV, or market cap versus realized cap. So market cap is literally just coin times circulating supply. The realized cap is the value in aggregate that coins have last moved on chain. So it kind of gives you a picture of realized profit versus unrealized profit. If the market cap is several multiples higher than the value of coins that have moved on chain recently, then there's a mismatch there, right? And that's what you're seeing, how this sort of lines up historically, is when that multiple gets high, above 5, let's say, between 7 and 8. Typically that's indicated we're a bit overheated. You can see in 2013, 2014, we've got to like 10 as a multiple, right? And the inverse is also true in a bear market when basically there's no more realized profit because in aggregate, coins have moved basically at the price or lower. That's what we're measuring here. And we typically see this last for quite some time. We typically see a parity of realized value and market cap in a bear market for quite some time before things shift in another direction. So 1, we're not there yet. And 2, it's a long ball game. So patience is definitely on your side here. I didn't even realize it, but MVRV can also be measured on Ethereum. It's a bit looser because of some of their on-chain movements and how things work for ETH, but I guess you can measure that still. And the signal is not as strong, not as stark, but still looks to be relatively intact. ETH in 2018, 2020 sort of cruised in this zone where realized value was equivalent or less than market cap. And then it quickly hit a 6 multiple there in early 2021. And ever since then, realized value is sort of catching up with current market cap. So ETH has less data. That's another knock against using something like this for ETH. But again, the signal looks to be there. The bottoms in price tend to correlate with an MVRV, which is below zero on the Z-score, right? And we're kind of there now with ETH. But you always have to be careful with signals on chains that are doing stuff that is different than Bitcoin, because that's where most of these metrics were sort of created off of. So caveat, but it does look acceptable as far as the zone at which things start to kick in for a bear market bottom, let's say. I want to talk about DXY really quick. We still see tons of correlation with legacy, with TradFi, with S&P, NASDAQ. We're inversely correlated with DXY. And historically, the best bull markets for crypto have been when we have a weak dollar or a weaker dollar, declining strength, let's say, in the dollar index. So again, there are caveats here. There are specificities to what you're talking about, but purely on a correlative basis, if we're looking at DXY weakness, we probably are seeing crypto strength. DXY has been in this range since 2015. So there's an argument to be made here is, if we start to see weakness in, let's say, 2023, will this pattern hold where we see crypto strength in 2023? Something to think about as we're sort of in the choppy doldrums. And along with that correlation discussion, the question becomes, who's sort of leading this on a geographic basis? We can measure that based on trading hours, based on who's awake when. These are referred to as sometimes kill zones in Forex. But if we look at US hours, Europe hours, and Asia hours, Asia and Europe in general have not been net sellers or net buyers since April. Pre-April, January to April, kind of a mixed bag one way or the other. But after April, the US session has been a strong net seller. This is by Arcane Research, by the way. Go follow them on Twitter. They put out great stuff. So this is just confirming what everybody's saying in regards to correlations and what you already know and feel, that yes, we are trading very closely with US hours, which are also seeing declines across the board in traditional markets. Some BTC TA for you. I look at this every week. I include it in the weekly newsletter we put together. This is the 200-week moving average in the green here, the neon green, and then the 2-year MA multiplier in the red, and the green and the white. And again, this is just giving whoever, me, you, trader, investor, a picture as far as overbought, oversold, and signals expectations, levels where the market woke up and kicked in, let's say. I won't say support, but we'll say sensitive price levels. How about that? Currently, that's around 22.2. The 2-year MA is around 36.1. And you always hesitate to call this, the DCA zone, because you never know when this signal will fail. You can't predict the future. Not investment advice, right? But historically, it has acted pretty strongly as a DCA zone. In this case, it's 22.2, between 22.2 and 36.1. So when you see me talking about, targets for the downside, or Valkyrie talking about targets for the downside, this is where it comes from, for the most part, is the 200-week moving average, which is currently around 22. I was talking about this inverted hammer as well last week into this week. We had 9 weeks of red, which for the first time ever, sort of unprecedented. And again, you can say, well, some of these were stronger than others. It's not really that big of a deal. Yeah, that's fine. It's still unusual for sure. Last week, we closed a candlestick known as an inverted hammer, which is a candlestick pattern you tend to see at the end of a downtrend. And it's all a probability game, right? If we start to see certain types of candlesticks historically that have made a difference in trend, we can say, okay, maybe this one, right? Maybe this one, it's green, it's this shape. What are the criteria for a reversal here? So in order to increase the probability of reversal, this week's candlestick needs to be above 32.4, which is currently the wick of last week's candlestick. And if you've never heard of any of this stuff, you might think it's a bunch of nonsense, but there's a sector of TA called Japanese candlesticks, which is where this type of analysis comes from. So those of you that know it are nodding your head, and those of you that don't think I'm crazy, and that's fine. But it is something people are watching. Now, alts have done, like I said, worse than BTC. ETH kind of in between, where it's done worse than BTC, done better than a lot of alts. If we look at Bitcoin dominance, which is a measure of Bitcoin's market cap versus alts, Bitcoin has continued to gain steam. You know, it's not going the opposite direction of the rest of the market, but it is declining less than the rest of the market. And you're seeing what I like to call Bitcoin season, something that you typically see in a bear market, which is a flight away from hyper risky altcoins and into Bitcoin or even stablecoins. But what we're seeing to me makes sense, and potentially you'll see a dominance of 50 to 60% or greater before, you know, the bear market is over, as they say. But another metric to watch. Flipping to ETH now real quick. Again, just like that MVRV, this is ETH's 2-year MA multiplier. It does give you a decent sense of overbought, oversold. The signals aren't quite as strong. Again, you can see there was a long period where if you're treating this metric as a DCA zone, you know, that's a big DCA zone. It paid off eventually, right? But there's no guarantee that if you're DCAing between 600 and 99, right, that this thing is going to reverse. So I hesitate to call it the DCA zone going forward, but, you know, it's certainly below its 2-year MA at this point in time. Sorry, the 1-year MA. Again, with ETH, there's less data, so you do have to change things slightly. You can't really look at the 2-year MA for ETH. It doesn't really make sense. We only have data to, like, you know, 2016. But it certainly sold off to a significant degree. The big supports I think that a lot of people are watching for ETH on a technical basis are the 2018 all-time high, which is around 1420, the yearly pivot, which is a measure mathematically of the highs and lows of the previous year, and it gives you the base pivot here, and then supports and resistances above or below that. There's a yearly pivot at around 1300, and then the 200-week moving average for ETH is somewhere around 1200. So really the zone is between 12 and 14. Should we go lower, where we will probably see a market reaction, as in a level where people are watching, right? And I've seen arguments for a descending triangle as well, if we're talking about TA chart patterns. It's certainly not there, as I like to say. You know, it's clearly, there's a diagonal here, there's a horizontal here. There are levels that people are watching. If this plays out, as some people expect, I do think that's how we get to that 12 and 14 zone, along with just other confluence in that level for support. On the flip side of that, we do have a growing bullish divergence where we're seeing lower lows in price, higher lows in RSI. Arguably, again, it's a bit wishy-washy because you're not really seeing lower lows in price, you're seeing equal lows, but it is a loose, a weak bullish divergence, I guess you'd call it. So TA-wise, we're kind of all over the place on ETH, but that's what you get in CHOP. ETHBTC, though, definitely breaking its ascending triangle, which is just the opposite of this descending triangle. To the downside, it broke its diagonal support there, broke below the yearly pivot. And the next stop really is probably 05. If this continues, that's a good psychological level. The 200-week moving average is thereabouts. And historically, ETH has had trouble up here just maintaining these highs. It tends to get excited and sell off very quickly. The hope here for the ETHBTC bulls was that you did have a chart pattern that was supportive of continuation in this case, as previously these chart patterns were not. We'll see what happens when the merge comes and if the triple halving actually lives up to the hype that many expect it to live up to. So we may see a world where ETHBTC dips to 05 and then catches up to 0.1 plus after the merge happens. You know, that's one decision tree possibility. Another possibility is nothing happens and, you know, ETH just continues at 05 or wherever it ends up. But it's certainly not done well against BTC over the past 10 weeks, let's say. And again, alts in general kind of getting crushed here in recent weeks. And we may be setting up for another type of falling wedge in DeFi land. This is a index on FTX based on market cap. And we're seeing signs for falling wedge, bull div here, which is a really prudent setup that most people pay attention to, that tends to lead to reversal. You know, it's quiet, it's understated, it's a lot of chop. But again, to me, it's not there. It's also extremely far away from the 200-day moving average. So if we're looking at signs of being mega oversold, that's one of them on a technical basis. You could have arguments that DeFi is in a slowing period because volumes have declined, users have declined, right? That's also one argument that can be made, certainly. And again, just broadly, if we look at BNB, ADA, Sol, DOT, nothing is doing amazing right now. It's maybe surprising BNB has held up as well as it has. BNB mirrors Ethereum in a lot of ways, price-wise, technicals, whereas some of these other newer chains like Sol and DOT have certainly just been hammered lately on the downside. So that's all for this one. Dislike, comment, share, subscribe. Let me know what I missed in the comments below. And happy trading.